Good morning, Ganesh, Vivek, Krishna, Raju. How you guys doing?
Morning.
Good morning.
How you guys doing this Sunday morning and afternoon for a couple of you? All right.
All well here, Sharat.
Thank you. Is my line audible well? Good.
Perfect.
Okay, everyone, I'm not going to be waiting for the rest of them to join on the call right away. So, it's 11:01. We'll begin as per schedule. I'm going to begin sharing my screen. Please let me know when you're able to see my screen. Is my screen visible?
Yes, sir.
Thank you for that, KK. All right. So today's workshop, or rather today's webinar that we're going to be concentrating on is predominantly to understand how we can put our savings or money that we keep liquid to much better use. Okay. And that's why the title of the presentation is more on the real cost of safety and ignorance. Right. So that said, what we're going to do now, today's agenda, understand the asset allocation myth. And then we're going to be taking common fixed income instruments that we have our monies parked in. And then we have two main portfolio retractors. So let's understand the asset allocation myth. Now, okay, guys, Sunday morning, I understand you probably are still in your on your bed. It's absolutely fine. Please have your video shared so it becomes easier for me to interact with you and I'm not just looking at screens. Thank you very much, Vivek, Ishwar, and Krishna. All right. So does anyone want to quickly tell me what asset allocation is? No right answers, no wrong answers, just to build a interaction among the group. Any idea what asset allocation is?
Various instruments is to at least where you park your money.
Okay, so like we say, don't have your money parked. Have your money parked in different baskets, not all of them in one place, right? Okay, so I'm going to share that is a big lie. The reason it's a lie is because it has not kept one aspect in mind. Any guesses why? Okay, so there are two stages to wealth creation. Sorry, there are two stages to wealth creation. All right. First stage is wealth accumulation. The next stage is wealth distribution. Wealth distribution is basically the stage when you're getting to retirement and after. Prior to retirement stage is everything to do with wealth accumulation. Now, why is this so important? Is because when you're going to go about earning money, your intent for earning money is to go about funding your financial goals, not to make money, not to make the best returns possible, not to go about chasing safety. The main aspiration of earning money during your working years, which is your wealth accumulation years, is to go about accomplishing your financial goals. All good? Wealth distribution phase is when you have got your large sums of money and your only purpose of going to be spending money predominantly is going to be on retirement. Not that you'll not have other expenses, but your main expense will be retirement. Okay, that's when asset allocation works through and through as per whatever readings that we have. So typically with the kind of reading that we have, give me a second. Shobita is saying make me co-host. Okay, 1 second, Shobita. I've made you co-host. Okay, there you are. So what have we been told about asset allocation? We've been told that if you are 40 years of age, the ideal way to the ideal formula or the rule of thumb would be minus 100 to whatever your age is, and that should be the amount of money you should have in equity, and then some bit of money in real estate, some bit of money in gold. The reason why this doesn't make sense is because let's assume I have 1 CR today, or let's say I have 25 lakhs available with me today. What do I want to do with that 25 lakhs? Now, if it says put certain amount of money in real estate or put certain money, let's say in fixed income instrument that has got a lock-in of how many ever years, and if I need the money in the next 1 year, what happens to that money? So basically where I'm getting at, the reason why this is a lie is in your wealth accumulation phase, that is from the time that you're from the first day of your work till the time that you're planning to retire or a couple of years prior to that, the main agenda is going to be accomplishing financial goals. Therefore, the money that you're going to be putting in is going to be kept in with your goal in mind. So if I have a goal to pull this money out after 7 years, or let's say I want to buy a car after 7 years, or I'm looking for a home renovation after 3 years, the tenure of the goal decides your instrument and not otherwise. All okay so far? All good? So we have wealth creation products, and then we have wealth preservation products. Okay, so it's, in other words, it's wealth creation and savings oriented products. All good? What are savings product? Anything that you have a fixed income or fixed return showing up. Typical instruments of these sorts are being savings, fixed deposits, PPFs, PFs, anything that has a fixed rate of return. Okay, and wealth creation products are those that generally go about giving you double-digit return. More or less, the inherent habit of that instrument is to go about giving you double-digit returns. Okay. Now, I am not going to be talking anything to about wealth creation products. I'm going to be talking purely on wealth preservation, simply because this portion of money that we're going to be talking for today's webinar is going to be mainly focused on instruments or on goals that you have in the next 1 to 3 years time. All good? If it is, please show me a thumbs up. All right, awesome. Now that we've understood this piece, let's go back to my PPT. And now we've understood the asset allocation myth. So common avenues that we have for savings is 1, your savings account, and 2, your fixed deposits and recurring deposits. While there are so many more, the only 2 instruments I'm focusing on right now is because bulk of where our money is lying down. I mean, does anybody have money elsewhere other than these 2 instruments? Predominantly, when the money comes in, if there is extra liquidity, it's either sitting down in our savings account or it's in our fixed deposit. Is that correct? Yes, no,
Yeah.
maybe?
Yes.
Right? So
It's choppy. I don't know if it's just me, but I'm in the line.
that said, what I'm going to be doing now, sorry, I didn't quite get that. Is there a disturbance in my line?
No,
Your line is clear. Yeah.
So thank you for that confirmation. All right, I'm going to quickly get to sharing our screen again. And so my question to all of you, is your money or is your savings making or losing money? How many of you know this? The money that you save in your savings account or the money that you save in your FDs, are they actually making money for you or are they losing money?
Losing money.
You're losing money. Yeah.
So all of you being existing families that work along with me, so I'm pretty sure we understand this, but yet we continue to have monies in our savings and fixed deposits. So first, what I'm going to be doing is I'm going to be showing why this is actually losing us money, and then what are the alternatives to that is what we're going to be looking at. Okay, so today, if you look at how things are in your savings account, right? Your savings account typically has returns anywhere between 3 to 3.5%. I'm talking about your standard banks, right? I mean, all established banks. We are talking at least 3.5% is what the interest rate that you're getting. Okay, so give me a second. Let me just change these numbers. Okay. 1 second. Okay, so we've got 3.5% being the nominal return. What do we understand by nominal return? Nominal return is any return that is just mentioned by this by the provider to whom you've lent your money. Okay, so when you see 3.5% or 7% or 6%, that is nominal return, right? So if I put a capital of 10 lakh rupees, my nominal return is at 35,000 rupees. Now, what are 2 of your largest wealth detractors? Two aspects that destroy your wealth. One, the answer is already here, which is income taxes. Nothing detracts your wealth as much as income taxes. Okay, so from year 1 all the way till the time that you're going to, say goodbye to this planet, you are going to be paying heavy on taxes. Okay, so I have gone about putting in different tax slabs, which if you see here, I mean, I'll pull that up in just a minute, but I don't want to do that just as yet because there's another pointer. Any guesses on what's the other wealth detractor?
Inflation.
Who said that?
Zubin.
Hey, hi. Zubin, very nice. Well done. Right? Awesome. We've had our discussion a couple of times around that. So I think that's why it came pretty easy. But here it is. Right? Here's our tax slabs, and here's inflation. Now, to keep things simple, I'm going to explain these things which are very technical in nature. I'm going to keep it as simple as we can get. Taxes need not, we don't need to get there. Whatever is your tax slab, you will end up paying taxes on that, right? 10, 20, 30%. I'm not taking the 35, the 40%, and then on that surcharge, and then the 1 crore above, because that's just going to get a little too confusing. To keep things very simple, I'm just keeping the 10%, 20%, and 30% slab without the surcharge. Okay. Furthermore, I'm going to keep inflation right now at 0%. Can anybody tell me what does inflation mean? Keep it very simple. No technical terms. What does inflation mean?
It costs you more.
Cost of living gradually increasing, or cost of basic necessities that's increasing gradually.
Absolutely. Absolutely. So in other words, if today I have 1 lakh rupees, after 1 year, if my inflation rate is at 6%, which means my 1 lakh has gone down by 6%. Is that correct? Which is, in other words, now the worth of that is 94,000, right? So if there is power of compounding being the 8th wonder, right? Power of inflation is the 9th wonder when it goes about taking wealth away. Now, why is this so important is because of this one simple reason, right? I'm getting back to sharing my screen. Now, as you can see here, if my capital invested was at 10 lakh rupees, my nominal rate of return is 3.5%. My money lost to taxes is at 3,500 on the 10% tax slab. I am now going to start talking about the 30% tax slab, not for anything else, because bulk of my families are in the 30% tax bracket, right? So now that we've got this piece, you see your post-taxes return is 24,500 rupees. Net, what you've earned is 24,500. Now, at 10 lakh rupees, you're losing every year 3,500 rupees in taxes alone, right? Money lost to taxes, sorry. In this case, it's 10,500 under the 30% tax bracket. For some of us, that might be large amounts of money. For some of us, it might just mean pocket change. But my point is, why let go of this money, right? Now, added to this, let's say, I know I'm saying this because I've seen some of our savings accounts, and I know the kind of money that is being sitting down there for a long period of time, right? Now, let's say I've got 6% being my inflation. Now, my actual returns after accounting for inflation and taxes is a minus 35,000. So how much I have lost in taxes is right there, and how much I have lost in inflation is right here. Okay, why is this so important? The reason I'm saying this is so important is because as long as it's in savings account, it's still fine. But I still know a lot of us who go about keeping our monies in FDs just because it's a better earning instrument than savings bank account, assuming that we are chasing safety so that at least that money will be growing. So the money that we are kept in FDs is not the money that we are looking at using the next 1 or 2 years. What most of us use FDs for is a wealth creation product, while it's actually a savings product. See, what we need to understand when you have your money being invested is, are you getting real or rather tax adjusted real returns? Is that in the positive? What does that mean? If I'm earning, let's say 10% interest, if any instrument that I've parked my money in is earning me 10%, on 10%, how much am I losing up in taxes? If I'm in the 30% tax bracket, 30% minus 10%, in this case, it's minus 3%. Is that correct? So my actual return after taxes is 7%. Is that right? Excellent. And if my inflation is at 6%, now how much am I making? 1%. So year in, year out, I'm actually making only 1% returns. Therefore, please stop considering FD as a wealth creation product. If you're thinking that at least my money is safe, there are multiple other products where you can actually chase that kind of safety and make better tax adjusted returns, because how your money is taxed on incomes that are giving you fixed rate of returns is very different from where you have market linked instruments. Is all of this making sense? If it is, please show me a thumbs up. Awesome. Now, what are the alternatives that we have over here? Now, as far as 3.5%, this is for our savings bank account. But anybody knows what's the FD rate of return today? You can unmute your lines and quickly share your answers.
5.65 something.
You're with HDFC or Axis Bank, one of the two.
Yeah.
Anybody else? Okay, the average rate is around the 5.5, 5.75. But to make things, a little more, less scarier, let's say we are getting 6% here. Okay. Sorry, give me a second. So that is 6%. Now do we see how much of money have we actually gone about paying in taxes alone? That's 18,000. Prior to this, we were paying roughly to the tune of 10,500. Now that is the amount of money. In spite of this, your net return is still at just 18%. Okay, I will bring this back to 3.5% for a very specific reason, because now I will show you an alternative. Do we remember what was the alternative that I proposed earlier this year, sometime in the month of April?
Liquid loans.
Correct, right? So why liquid loans? One second. Why liquid loans? Because of all these different reasons. Now, I've already given you all a webinar. There is already pointers and email that is mentioned about why this company seems to be a better alternative when keeping your money just idle in savings bank account, right? Liquid loans as a product we offered purely as a replacement to your money lying in your savings bank account. Okay, as you can see here, the average rate of return is 8% IRR. What does IRR mean? Just because I keep 1 lakh rupees for 1 month, that doesn't mean I'm going to be making 8% on 1 lakh. I'll be making 8% on 1 lakh for 30 days. So PTR by 100, in this case, time will be 1 divided by 12 instead of 1. Okay, we need to know more about this. We can get on a separate call, but to keep things very simple, you will be getting 8% for the number of days that the money is left in this instrument. So that comes in, what's your minimum tenure? No tenure, no minimum lock-in at all. What am I referring to that? What am I referring that in this case? Like a savings bank account, you keep it for 20 days, you will get 3.5%. Likewise over here. The only difference between a savings bank account and liquid loans in this case is, if I'm pulling my money out, I need to give liquid loans 2 working days time for the money to hit my bank account. That's the only problem. So there is no minimum tenure, there is no lock-in, there is no exit load for pulling out your money. Why am I saying 8% while on the website it also shows 9%, sometimes 9.5 or 10%? It's simply because that is for money that is locked in. If ever you're going to be investing your money in liquid loans, please opt for the non-lock-in fund, no minimum tenure fund. Why? We will get to that in just a bit. But all clear so far? Now, is it worth all the headache of 8%? Just to make 8%, is it worth having to go about all the time transferring your money, putting that money to better use or whatever it is, right? Let's take a look. Now the nominal return at 8% is right over here. And the same calculation, right? Money that I've lost due to inflation is again same 60,000 rupees. But watch here. What was my net return at 35,000 has now come down to just 4,000 rupees, minus 4,000. But if I don't keep inflation, in mind, what's my post taxation number? My money post taxation is right here at 56,000. The difference in earning is about that much. Is that sufficient? Is that good amount of money? Now, obviously, we are not going to be putting in all 10 lakhs rupees in liquid loans right at the start, and it's going to take us some time. But let's say if it's only 1 lakh rupees, let's say if it's only 1 lakh rupees. So I'll take this number out and let's say I put this to just 1 lakh rupees and put that here as well. Okay. Now for no effort, just that extra 15 seconds or 20 seconds of logging to the platform, transferring your money, you're making an extra 3,100 rupees. Sorry. Yeah, you're making roughly around that 3,100 odd rupees. Is that good? So my point being, yes, I understand, Zubin, it might probably be not worth it, but when I'm talking about a small number at just 1 lakh rupees. But like I said, if you go about taking 10 lakhs, because this is if you see, I do not know why, but most people tend to keep about 5 lakhs to 7 lakhs idle in their bank account more often than not. Why? I don't know. So if you see the few reasons that I've got here in terms of why people go about still keeping money in banks and FDs is just for these simple reasons, right? First of all, we are not even aware of how much money are we actually losing to inflation and taxes. Yes, we understand taxes because that's only at the end of the year, but we don't understand how much inflation is costing us because, hey, I already have my capital. You see 1 lakh invested, you see after 1 year also 1 lakh invested, but what it can buy, that's a notional loss, which we're not booking till the time we actually take the money, or we're going to actually be using that money for some expense, right? Second being hassle-free, no headache, let it be there. Out of habit, I'm just keeping it there because this is what I've been doing forever. Next, chasing safety. And that's why when you're chasing safety, does it actually make sense? Right? This is the price that we're paying for safety. Sorry, just a sec. This is the price that we're paying for safety. Now, I just spoke about, let's take FDs as an example, right? So we have FDs being at 6%. Okay. Now, what are the alternatives to FDs? We bought instruments like Giraffe and we bought instruments like Asti. Why Asti? Why Giraffe? It's all covered in the other email videos. We'll talk about that later. But what's the average return that's coming from these instruments? Any guesses?
Anywhere between 12 to 18%.
All right, 12 to 18% is the right answer, Zubin. Thank you for sharing. So instead of taking 18%, instead of taking 15%, I'll take the bare minimum. Okay. So I'm taking this at 12%. All right. What's something here? My money lost to inflation, that's okay. Now, my nominal return at 6% in FDs is at 60,000 rupees. But here I make 1,20,000 rupees. I know this for a fact. Some of us makes bonuses. If I put that in quarterly numbers, that is just about that. So if you're making a 5 lakh bonus and you divide this in 4 quarters, isn't that the number that we're talking about? You got all of this for just being a little more wiser and more prudent with your money. Money that is being kept idle. Okay. Safety is a different aspect. We'll get to safety in just a bit. But for every other thing, in terms of habit, in terms of convenience, in fact, or not knowing, these should not be the reasons for having money kept over there. Right? Now, watch this. Money lost in taxes. Right over here. How much did I lose in taxes? 18,000 rupees. I've lost in taxes over here 36,000 rupees. Yet, my returns post taxes is at 24,000. Right? Sorry, post-tax return is at 84,000 rupees. After paying twice as more in the previous case. And now, what does this net return actually mean? 1 second. There you are. Money lost to inflation and taxes, 96,000 rupees. And in spite of having 96,000 go up, I still have an outperformance of 42,000 rupees. So let me ask you a question. In this case, is the real return positive or negative? How many of you say negative? At inflation being 6%. Correct. It is negative, right? In Asti's case, where we're making a 12% return. Okay. Is that positive? Is the real return positive or negative? So in other words, thank you. So in other words, where I'm getting at with this is, If you have to make your money work harder, or if it has to give you meaningful returns, right? Look at it giving you at least double-digit return and nothing less. If your inflation is anywhere in the neighborhood of 6% or 7%, earning less than 10% is actually losing money for saving up that money. Is this all making sense? Right? So I wanted to keep this webinar very, very short. And like you see, I've covered on all the important topics that is required in terms of why you should start looking at alternatives when compared to your FDs and your savings account, right? The reasons for the same are already being given. And now we'll quickly touch upon what liquid loans as an alternative offers you right there. There is no minimum lock-in. So from today, if you're looking at having an alternative to your savings bank account, please look at liquid loans. Don't look at having your money locked. Keep it at the no lock-in period. Right? Next, we have Giraffe, where as you can see, they have already dispersed 475 crores of money. And up till now, there has been no defaults or no delays. Right? We don't know whether there will be delays or defaults. We don't know that just as yet. There is a risk angle to it. But at this point in time, since 2021, with that kind of money being dispersed, there has been no delays whatsoever. The minimum ticket size, as we already know, is 1 lakh rupees. And investment tenure is anywhere between 3 months to 36 months. Now, why did I say that you do not have your money locked in with liquid loans if you're getting an extra 1%? Because Giraffe has bill discounting as an alternative, where your money being locked for 60 to 90 days time, you get a return of anywhere between 10 to 12%. Is this making sense? So ideally, what I would do and what I'm currently doing with my money is, let's say I had about 10 lakh rupees sitting down in my savings account. Instead of keeping that money in my savings account, I move all 10 lakh rupees to liquid loans. See, this is me. This is my risk appetite. I'm okay. I understand that if even there is a default with liquid loans, it's not going to be to the extent, the loan amount will not be to the extent that I will be losing on my earnings from my savings account. Is this making sense? So this is me. If you're comfortable just having 1 lakh, 2 lakh, that is up to you, right? But just start looking at exploring these different alternatives. So my 10 lakh sits over here. Whenever there's an opportunity that comes from Giraffe, I pull the money out from here and then go about funding it for that 12% or 10% as against just making 8%. Is all of this making sense? Yes, it is a little bit of extra effort. It is a little bit of extra involvement of your time. But, we either play now and pay later or play now and pay later. So that's the alternative that we currently have for ourselves, right? So your return is anywhere between 10 to 18%. And then we have ASTI as another alternative, where the operation started from 2021. 8 projects have been there. They've raised about 6.75 crores. Minimum ticket sizes at 50. And your tenure out here, this is incorrect. Okay, the tenure here is anywhere from 12 months to 18 months time. So that is 12 to 18 months. Sorry about that typo there. But your return is anywhere between 12 to 15% again. Okay. Now, how safe is your money with all these instruments? Let's understand. All of these are collateral backed. Except liquid loan, all of this is collateral backed. The money that is being raised by investors in these instruments is not going to run the operations of the company. It's going to fund the loans that they're doing. The operations money is being funded from the money that is being raised from equity investors. Our money, investors' money that is meant for lending, is never gone for operational expenses. This is all making sense. This is very important. I'm not using my money. I'm not using the raised money from investors to run my operations. It's used only for having deployed, all going through proper escrows and a structured special purpose vehicle. All good so far? Now, in spite of all of this, there is still an element of risk, right? There is still an element of risk. And therefore, what is it that we're supposed to be doing, right? Don't go all guns blazing on this one just as yet. For those of you who've not got your KYCs done for each of these instruments, please reach out to Sagar, get that KYC piece done, okay? Keep a limit to how much you'd like to start getting your exposure to each of these instruments, right? I want you to have no more. If you're of the habit of having your emergency fund kept in your savings account, or let's say kept in, let's say, a liquid fund, it would be a good idea to have at least 25 to 50% of that money kept in liquid loans. Okay. Needless to mention, please go ahead and also have a couple of credit cards unused so that that can come in as your emergency fund if the need arises as well. I'm not saying use your credit cards as an emergency fund. I'm just saying keep that handy so that if there are small purchases, you don't need to go about pulling out from your investments or these short-term investments that you've got. Okay, an emergency fund is absolutely important. Therefore, 50% of your emergency fund should always be in traditional instruments where you know you can never lose your money. Savings account, FD, for example, from popular banks that we have, the HDFC, ICICI, Axis, SBIs of the world. Okay, rest of the money, 20 to 25% to 50%, have it in these new age instruments like I mentioned, liquid loans in this case. Good. Instead of moving on, first of all, any money in FD over and above your emergency fund should never, ever, ever, ever be in FDs. You should have better alternatives, better tax efficient instruments for however short the tenure is, because there's a better alternative from a tax angle to it. Okay. But if you'd like to, not want to explore, get yourself exposed to interest risk, credit rate risk, and all the other risks that comes along with fixed income instruments, you can possibly look at ASTI and at Giraffe as an alternative. With Giraffe, what's your risk? The possibility of the companies defaulting. And therefore, if I have 10 lakhs in FDs, I'm not going to put all 10 lakhs in FDs in one go, in Giraffe in one go. I'm going to be putting in minimum investments across different products of theirs. So today, if Giraffe has got a bill discounting option, I will put one of the instruments, 1 lakh rupees in that instrument. Then they've probably got a company leasing. I'll put another 1 lakh over there. While most of you are already aware of this, I'm still highlighting this so that there is a refresher on this and we have not got any confusions as far as these alternatives are concerned. Okay, so I'll quickly share with you all how these things are as far as my investments are concerned, right? Give me a second. So as you can see, my money in liquid loans out here, I've got 2,50,000 rupees parked, right? Now you'll say, Sharat, is that all the emergency fund money that we have? Remember, I said I will not go beyond 50%, right? And I have my cards, and then I have my money in my partnership account as well. So that's here, right? It tells me how much of my money, what's the kind of growth that I've had, my annualized returns. If I need any further details, I can go about looking at my portfolio, get to know where my money is being lent, to whom it is lent, at what interest rate, so on and so forth. I want to pull out a monthly account statement. These statements are available for us to take a look at. If you're not aware of this just as yet, please reach out to Sagar and he'll give you all a quick download on how you can go about pulling up these statements, right? So now that is as far as liquid loans is concerned. As far as Giraffe is concerned, give me a second. Let me log in, please. I'm putting in my OTP. So as you can see here, as soon as you log in, it will show you all the different opportunities. But as and when you've got your investments done, it gives you a breakup of all the places where your money is invested, right? You've got venture debt, corporate debt, invoice discounting. I don't have an asset-backed leasing instrument just as yet, because when I had the money, their opportunities were not there. And when they had the opportunity, I probably didn't have the liquidity, right? But at this point in time, my gross return earned is around 1,08,000 rupees. I need you all to know each of my investments that was invested, right? So if I go to investments out here, and as you can see here, right, my very first investment was on the 27th of May, right? And in spite of that, I have earned so far, gross returns earned is at 1,08,000 rupees. Can anybody tell me what is my actual returns? Absolute. I mean, IRR is what we got to look at, but tell me ballpark, what do you think will this number be? Anybody? You can unmute your lines. Okay.
More than 10% for sure.
That's right, Nagbhushan. So while we're looking at 10,000, the 10%, that's not actually the fact. And the reason for that being, give me a second. The reason for that being, you see, all of this money didn't go on the first date. One came in the month of 6th of June. So 50% of my money came on 6th of June. Then after that, some more came in July. Then after that, some came in August. So quite frankly, it's much higher than 10%, right? But simplicity sakes, 10%, is that the number that we're chasing? Now, what was my better alternative? I had the money kept to be sitting down in an FD. Right here, most of us are wary about having to put this money in alternate instruments because we don't know how to track them. We don't know whether we will be able to understand and see where the money is going, so on and so forth. Now, once you understand why Giraffe and how Giraffe makes sure that they've got good assets being listed on their platform, then it becomes that much more easy for us, right? See, I'm getting 19% in one of these instruments. I'm getting 14.493. Obviously, all of these are taxed. So needless to mention, if I have my money in FDs also, I'm going to be taxed at my tax lab. And if I'm going to have in these kind of fixed income also, I'm going to be taxed at this rate. But what is important out here is that is almost 2 times or 2.5 times that of my FD return. Is this making sense? Now, one of the easiest things that you can go about doing in order to make this tax outflow much lesser, start building this portfolio in your spouse's name if they are on a lower tax bracket. Alternatively, if you all are comfortable, if you all are in talking terms about money with your parents, I'm saying talking terms, not that you all don't talk, it's just talking terms about money, because some people, it's like in my case, my money is my money, my parents' money is parents' money. Let them deal with it how they like to do it, right? And I don't want to get into that for the variety of challenges that comes along with. So my point being, if you are in talking terms, you all are comfortable talking about money matters with your parents, ask them to possibly have a joint account with you guys and then move this, because then at least that money is getting saved. Now, would I do it if am I doing that? No, I'm not doing it, because it's not worth my peace of mind. It's not worth my convenience, right? But if you all are at a better place where you all are having joint accounts, you all are discussing, then it's absolutely worth it, because like I said, a difference in taxation is right here, right? Imagine if they are in the 10% tax bracket and you're in if they are in the 10% tax bracket and you're in the 30% tax bracket, that's the difference in taxes. Money lost to taxes right there, 12,000 to 36,000. You're talking roughly to the tune of 24,000 rupees. Now, while 24,000 rupees might not be such a large amount of money, remember your parents don't know about these alternatives. So slowly and steadily, when they start getting used to these numbers, right? Imagine the kind of money that they can also go about saving from a tax angle and from, more importantly, an inflation angle. Okay, I have covered quite a bit of ground so far. And before I go to the learning, I'd like to see if there is any questions, any clarifications that either of you have. So you can unmute your lines and ask a question. Any of you?
Sharath, one question. I mean, when you say joint account, do we have to, in the platforms, we'll have to go and create it as a joint account? Or
No. I'm talking about your bank account being a joint account.
Oh, okay.
The investment will definitely be in your parents' name, because ultimately taxation goes in the name of the investor.
Perfect. Okay, clear.
I have another alternative to this also. We'll talk about that in just a bit. But any other questions?
Sharath, one point on the...
Thank you, Funny. Go ahead.
Yeah, so one point on this liquid loan part, right, when you're starting. So the liquid loans also, it stays in escrow account, or they
all of them, Funny.
All of them in escrow.
All of them in escrow account. I mean, if you want to see how this works, now that you bring this up, give me a second. Okay, here we are. Do you see this format?
Yeah, I'm seeing it, but the font is a bit smaller.
Okay. So what ends up happening is Liquid Loans takes the list of borrowers from here. All the money goes to the IDBI trustee.
Okay.
The money is very clearly defined that it cannot go for anything else apart from lending to the borrowers or to the product manufacturers and coming back.
That's good. Yeah. That was the one doubt which was not clarified on the call. So just maybe it was not evident on the call.
No, no worries. No. So why I'm doing this, why I'm highlighting this, because until now, the other fixed income instrument that we offered for most of our families was with FinZ, right? Now,
Yeah.
unlike all these other instruments, that was not collateral backed. Those are not collateral backed. This one out here, while FinZ and Liquid Loan operate pretty much on the same ground, ASTI and Giraffe have collateral back to it. Like if you look at Giraffe, whether you're talking invoice discounting, if you're talking about corporate leasing, venture debt, they've got assets of that underlying product taken as a collateral. ASTI has got anywhere between 1.2 to 1.3 x of the collateral, that is of the money that is being raised as a collateral. So that's why these instruments seem to be a much better alternative when compared to FinZ. Okay, so FinZ is not an alternative to liquid loans. They are two separate products altogether. Although both of them are in the peer-to-peer space, they are two different products. So we'll not come. FinZ could be a good comparison to ASTI and Giraffe, and I would prefer both of these any day when compared to FinZ, just because of that one aspect of non-collateralized assets. Any other questions? By the way, very nice question, Funny. Thank you for asking. Shrikant, Nagraj, Sampath, any questions at all? Okay, cool then. So what we're going to do is we're going to get to the learnings that we have for this. So very quickly, we've now understood the difference between savings and wealth creation products. Saving products are mainly designed to go about protecting your capital. Use them for just that. Don't look at them for creating wealth. Wealth creation products are generally those that will give you at least double-digit returns, because you have to keep inflation and taxes in mind. Okay, lesser taxes, inflation you can't reduce because it's a universal number, but lesser taxes, more optimized kind of instruments are where you've got to look at for creating wealth. Right? Learning number 2, as we've got to understand, there are two wealth retractors there: taxes and inflation. Nothing hurts your portfolio than these. Unfortunately, when you're looking at returns in your insurances, when you're looking at returns from your savings bank FDs, they just tell you what you will earn. What your real return, tax-adjusted real return, will generally be a negative return if you're looking at single-digit instruments. Okay. Last but not the least, have an investment account. Now, why am I saying this? Okay, we didn't discuss this, but I'm telling you all, let's all look at having an investment account. What has ended up happening for some of you who've been with me for over 3 years, 4 years now, there have been multiple instruments I've given you all where you're getting a quarterly payout or a half-yearly payout. Now, for those of you who've gone about having that money reinvested in mutual funds, this point is not valid. But now let's talk about something like a corporate lease or a venture debt, where you're going to be making a monthly payout coming in. This money, if it is in your mix, and for most of us, that's pocket change, right? And then when this money gets actually spent with all the other expenses that are going in your main account, you don't tend to see where this interest actually came in. So one of the best things that you can do is look at alternate banks that are currently there. Like, for example, an IDFC First Bank, an IndusInd Bank. Previously, I would say Yes Bank, but now I'm probably, I'm in mixed opinion about it. But AU Bank is another bank that you can look at, right? Why? Their savings bank accounts give you returns anywhere between 4 to 7%, depending on the minimum investment that you're putting in. So if you're very concerned about your safety of your capital and you don't want to take chances with a liquid loan or a Giraffe for that matter, at least have your money going in instruments that are giving you 2%, 2.5% extra over and above your savings bank account in any case. Like, for example, right now, I think for all of us who have accounts with Citibank, Citibank, I think, if I'm not mistaken, is giving us about a return of anywhere between 4.75% for your FDs. Now, for the same money, if it's just saving savings account in another bank that is giving you 6%, you're making that extra bit of money coming in. I'm not talking FDs, but I'm just saying, these are small things that you have to just take a 1 day, 2 day kind of a timeout, and then make these accounts work that much more harder for no extra effort on an ongoing basis. For example, I'm actually looking at partnering up with a company called AU Bank. Okay. And AU Bank, what I liked about them the most, I can make up to 7% return. More importantly, I can make up to 1% of my entire expenses. So if I'm spending on certain amounts of money with the minimum amount being 1,000 rupees, I make 1% as cashback.
So
this is a savings account. This is not a credit card. Okay. So yeah, go ahead, Ishwar. I think you just had a question.
Don't we need to maintain a balance in those accounts, right? So that we can earn more than 6 to 7%.
You would anyways maintain a balance. No? The point is you would anyways keep that kind of liquidity, right? Now today, where are you keeping your emergency fund?
So this is apart from the account from where our SAP is going. Is that so, or?
I would suggest take the time out and have a separate investments account. Instead of now, currently, what are you doing, Ishwar? You have your main salary account. From your salary, all expenses are going. From your salary, also all the investments are going. Is that correct?
No. I have a separate investment account and another.
Then in that case, you're good. That case, you're good. Now ask yourself, if your investment account for your savings is giving you how much return? If it's just giving you 4% or 3.5%, then wouldn't it make sense to probably move that to a higher yielding instrument?
Yeah.
That's what I'm proposing. Okay. What I'm doing for myself, okay, I am going to be reaching out to AU Bank and see how the service and everything is. Then if that partnership does happen, then I'll have them introduced to all of you as my families. But my point being, what I'm doing right now, I'm going to be stopping all my SIPs from my primary account and going to be moving this to AU Bank. Okay. Because at any point in time, there is 5 lakh to 7 lakh sitting down not because I don't want to put all this money in my liquid loans and everything, because I have to start, you all know this, right? Anything that I introduce to my audience, I go about having my money invested. Now I am going to be looking at pre-listed IPOs as another asset class, and I need money for that as well. Therefore, there's always that kind of liquidity that is there. Now, instead of earning 3.5%, let me keep 2.5% or whatever it is for that matter, right? I'm not doing any extra effort. All good? Right? So that was that. And so like we had the learning, have an investment account like we just said. And warning, please keep your keep your percentages in mind. Don't go all guns blazing right now. If we've not discussed percentages in terms of how much money should be allocated to each of these instruments, let's get on another call. I know some of you have already got your money in liquid loans, in fact, in all 3 of these assets. Okay. The aspiration is we will not have any more than 10% of your investable money or 10% of your paper-based portfolio in alternate assets. Okay. Alternate assets being Asti and Giraffe. Okay. Why are we doing that? Because again, they are alternate assets. These are mainly startups. These companies are, although well funded or, founded by good management with proven track record and all of that. We want to go slowly, right? We are not doing anything until now. We will start doing these, slowly and steadily. We'll not just, I'll not wait for, 10 months to deploy 10 lakh rupees. Don't do that. Go slowly and steadily, because God forbidding there is even one instrument that goes bust. You are going bust with only 1 lakh rupees, so it's getting delayed or it's getting postponed for some time. It's only with 1 lakh rupees of 50,000 and it's not with the entire 5 lakhs or 10 lakhs. Right? So that's the warning. Next steps, if you have not had your KYCs, if you have not had this discussed, if you still have questions, arrange a call with Sagar, drop us a message in the WhatsApp group that we have for all of our, that you'll have for our respective families. And then Sagar will, have a call with you, walk you all through all these pros and cons, and get your KYCs or get your unstuck for wherever this is stuck for you all at this time, right? And with that, we have come to an end of today's webinar. I'm glad that we were just 5 minutes delay extended when compared to my traditional 15-20 minutes kind of a delay. Any questions before I call it a day? Anything at all?
So we have these 4 thanks for the information. So we have 4 fixed investment options have been provided, right? So how would you distribute our money in each of these instruments?
Good. Okay. So I'll make it even more simpler now, Ishwar. Okay. See, what kind of money should sit down in your savings account? There are 2 kinds of money. One is your emergency money, and one is your money that you would want to go about investing when the markets are down. Correct? or you'd probably
Right.
like to explore other instruments. These are the only two reasons why you need to have money liquid. Okay. Most of us tend to keep it in a savings bank account. A little more prudent families go about keeping it in an FD. Okay. So money that is meant for your emergency fund, less than 50% of that, and money that is kept for other instruments in the future, okay, that can go to liquid loans. Good so far? Money that you've kept in your FDs, keeping a wealth creation aspect in mind, that you don't want to have all your monies in mutual fund, right? Those instruments, that money can go in instruments like Giraffe and Asti, slowly and steadily.
Right.
Did I answer that question for you, Ishwar?
Yeah. Kind of. It depends upon how much you want to allot, based on what you want to do.
Correct. Like for example, now you said, okay, you know what, Sharat, my SIPs are already at 1 lakh rupees, but I towards the end of the month, there is an extra 5,000, there's an extra 20,000 that keeps getting generated because cash flows are different per month. Okay, so what do I do with that extra 5,000? That 5,000 or 10,000 or 20,000 will actually go and sit down in liquid loans because you're making 8% on it, as against making 4% or 3% or 6% in FDs. Making sense? Let that money accumulate to a decent number. And when you get another instrument that can give you wealth creation based products, then you can transfer the money from liquid loans and put it to those products.
Yeah, and it would be still prudent to have a KYC done so that you can just pull.
You must, because all of these is white money. There is no way. I mean, I have no solution for black money. So if you're making white money,
in the sense that
all instruments.
Yeah. If you're not going to invest in any of these instruments, in the next month or so, at least get the KYC done. So is that something?
Yeah, absolutely.
Okay.
Getting a KYC done has no bearing whether you're going to invest or not invest. It just gets you at least one step closer to getting a particular activity done as against not getting started at all.
Yeah, to add one more question, right? So you talked about this investment account, right? So are we going to have this SIP pulled out from this investment account, or?
So honestly, Ishwar, for me, I'm first, like I said, I'm exploring this for myself first, right? Okay. And I'll tell you why did this thought even come to me? Giraffe, except for their bill discounting, okay? Except for their bill discounting, all their other products will be giving me a monthly payout. Okay. Now imagine if I like this will cart, I put 5 lakh rupees, right? 5 lakhs, if I put 10%, 10% is 50,000 rupees for the year. 10% of 5 lakhs is 50,000 rupees. 50,000 rupees divided by 12, okay, is how much? Almost 4,000 rupees for the month. This 4,000 rupees will come to my bank account. And if it is coming to my main bank account, which it is actually the story right now, okay, or my investment account, which other investments are going, I'm never going to see how much money is actually coming in interest, because 4,000, while I will not say it's pocket change, but it gets mixed up with all the other expenses that are going to go out. And therefore, not to lose track of this money that is coming in, that's why I looked at having another account for this.
And plus, they have provide additional interest, right? So
that is another story. That's another story. I selected this particular bank account with the higher interest in mind. But the purpose of having a separate account for all these investments was so that when my accountant goes about filing my returns at the end of the year, I can just pull up one statement and he will not ask me for anything else. So all credits are coming because of interest payouts. All debits are happening because of these instruments in fixed income. As simple.
But to add to that, right, I have invested in my wife's name, right, in these.
Right.
I mean, I don't have an option for, should I still consider having another account to have the payouts into this investment account? Because
you ask yourself, Ishwar. No, ask yourself the same question again. Are you okay with 4%? Are you okay with 7%? For the time that the money is going to the account.
No. Yeah. Extra 2-3%. Yeah, I want that. Yes.
It's a one-time headache in all our busy lives, in all the challenges that we have. I mean, AU Bank came home. They opened Shobita's account in less than 10 minutes. Mine account was not opened yet because they needed my thumbprint and my OTPs. So in 10 minutes, the entire account opening was done. That it's a one-time hassle. But if one-time hassle can give me a recurring basis, a month-on-month kind of extra benefits, then why not? So that's the challenge.
So assume that I may not be able to maintain. Okay, you are exploring it. That's fine. So we'll talk about it in detail. No
Sure.
issues.
All right. Any other questions, ladies and gentlemen? Alrighty then. I think we've covered pretty much everything there is to be covered. You guys have a lovely weekend. Oh, sorry, a lovely Sunday of whatever is left over. And I will talk to you when I talk to you next. All right. Happy Sunday. Good day, bye.
Thank you. Bye-bye.
Thank you.
Nice sessions.
Bye-bye.
Thanks.
Thank you. Bye.
Bye. Bye.
Thanks, Sharat. Bye.